What does a candlestick chart actually show, and how can it help us understand market movements? If you've ever looked at a trading screen or a financial website, you've probably seen these strange, rectangular shapes with lines sticking out of them. But what do they really mean? A candlestick chart is a way of visualizing the price action of a security, like a stock or a cryptocurrency, over time. Think of it like a timeline of price movements, where each candlestick represents a specific period, like a day or an hour. The body of the candlestick shows the opening and closing prices, while the lines, or wicks, show the highest and lowest prices during that period. And here's the surprising part. By looking at the shape and color of these candlesticks, traders can gain insights into the market's mood and make more informed decisions. But to really understand what's going on, we need to dive deeper into the world of candlestick charts and explore how they're constructed, what the different patterns mean, and how they can be used to analyze market trends. By the end of this video, you'll have a clear understanding of what a candlestick chart actually shows and how it can help you navigate the world of trading. Vocabulary: candlestick, chart, security, cryptocurrency. What do the individual parts of candlestick chart actually tell us about market activity? Let's break it down. A candlestick chart is made up of individual candles, each representing a specific time period, like a day or an hour. Each candle has four main components: the open, high, low, and close. Think of these like the vital signs of market activity. They give us a snapshot of what happened during that time period. The open is the price at the start of the period. The high is the highest price reached. The low is the lowest price. And the close is the price at the end of the period. These four components work together to give us a picture of market sentiment. If the close is higher than the open, it's like a pulse is getting stronger, indicating buying pressure. And here's the part most people don't know. The relationship between these components can vary greatly, and that variation is what makes candlestick charts so useful for understanding market trends. For example, a long candle with a small body and long wicks can indicate a lot of volatility, like a heartbeat that's all over the place. By looking at these components and how they interact, we can start to see patterns and trends emerge, and that's what we'll explore next. What does the color of a candlestick actually tell us about market movement? And how do we use this information to understand the story of a stock or asset's price journey? Let's break it down. The color of the candle, either green or red, indicates whether the price closed higher or lower than it opened. This is crucial because it gives us a snapshot of market sentiment during that specific time frame. If the candle is green, it means the price closed higher than it opened, indicating a bullish trend. On the other hand, a red candle means the price closed lower, suggesting a bearish trend. But here's the part most people don't fully understand. The direction of the candle, either up or down, shows the overall trend, but it's the combination of the body and the wicks that reveals the market's true sentiment. Think of the body as the main event, representing the opening and closing prices, and the wicks as the whispers of the market, showing the highest and lowest prices reached during that period. The length and position of these wicks can indicate the level of volatility and the strength of the trend. For instance, a long wick at the top of a candle can suggest that buyers pushed the price up, but sellers resisted, causing it to fall back. And here's the surprising part. By analyzing these components together, we can start to see patterns that reveal more about the market's mood than just the simple color or direction of the candle. So, let's dive deeper into how these patterns emerge and what they can tell us about the markets. Vocabulary: volatility, sentiment, bullish, bearish, resistance. What if the colors and directions we've been looking at are just the beginning, and there are actually specific patterns within these candlestick charts that can give us a deeper understanding of market sentiment? And here's the surprising part. Certain patterns, like the hammer, shooting star, or engulfing patterns, can give us clues about potential reversals or continuations of trends. Think of these patterns like a conversation between buyers and sellers. The hammer pattern, for example, is like a buyer saying, "I'm not giving up yet," after a downtrend, while the shooting star pattern is like a seller saying, "I've had enough," after an uptrend. The engulfing pattern is like a strong opinion from one side of the market, overwhelming the other side. Understanding these patterns can help us navigate the markets more effectively by giving us a sense of how other traders are feeling about the market. It's not about predicting the future, but about being aware of the currents that are driving the market right now. By recognizing these patterns, we can gain a better understanding of the underlying market sentiment, and that's a powerful tool for anyone looking to make informed decisions. What if candlestick charts aren't the only tool you need to understand the markets, but rather one piece of a larger puzzle? While they can be incredibly useful in deciphering market sentiment and identifying potential trends, they shouldn't be used in isolation. Think of candlestick charts like a map. They can show you the landscape, but they won't tell you what's beneath the surface. And here's the surprising part. Combining candlestick charts with other forms of analysis, like technical indicators or fundamental analysis, can provide a much more complete picture of the markets. Technical indicators, such as moving averages or relative strength index, can help confirm the trends you're seeing in the candlestick charts, while fundamental analysis can give you a deeper understanding of the underlying factors driving those trends. For example, if you're looking at a candlestick chart for a particular stock and you see a bullish pattern, but the company's financials are weak, that's a red flag. And it's essential to remember that no single tool is foolproof. Even the most experienced analysts use a combination of methods to make informed decisions. By understanding the strengths and limitations of candlestick charts, you can use them more effectively and make more informed decisions. So, let's take a closer look at how to put it all together, and that's what we'll explore in the next part. Vocabulary, sentiment, indicators, fundamental, analysis, trends. So, to answer our original question, a candlestick chart shows us the story of market movements, with each candle representing a moment in time. Think of it like a series of snapshots that tell the tale of how prices have shifted during specific periods. And here's the surprising part. By understanding how to read these charts, you can gain a deeper insight into the markets. Each candle has its own little story, whether it's showing an upward climb or a downward plunge. The body of the candle tells us about the opening and closing price, while the wicks give us information about the high and low prices for that period. So, if you ever wonder how analysts can quickly gauge market trends and identify patterns, now you know. They're simply breaking down these snapshots to see the bigger picture. And remember, this is just one tool in a trader's toolkit. It's like having a map while exploring a new city. If you want to learn more about how to decode the markets and uncover even deeper insights, consider subscribing for more educational content. Who knew that understanding candlestick charts could be so enlightening?